All right. Um, this week we will cover bond and stock. So, we'll talk about the major characteristics of bond and stocks, and then the major part of our discussion will be the valuation of bond and stock. Okay. All right. Ellison, can you read the first part?
Sure, under bond,
Mhm.
okay. A certificate representing the issuer's indebtedness to the investors, the issuers, borrowers, two obligations to the investors/lenders, a specific rate of interest at fixed intervals, usually 6 months, a specific amount of money, principal or par value at maturity.
Okay, thank you. And uh, all right. Yeah, for a corporation to grow and expand in the industry, they continue to find some kind of profitable, attractive capital project. So they have to develop or identify profitable projects for the company and include them in their future like growth and expansion plan. Right? The next step, once they identify this attractive, the project, the next step, next question is how to finance those projects, right? How to support, how to finance those projects. Now, the typical way is they issue new security, new stock, new bond. They issue those new securities, new bonds, and new stocks, and raise capital. So they sell bonds, they sell common stock, and then raise their capital and use that one to support to finance those projects. Now the first one is bonds, right? So the company will issue these new bonds to investors, usually to institutional investors. That's the typical pattern. Like big company, big like mutual fund and pension fund or insurance company, they sell these bond securities to those companies, institutional investors. Now, once the company sell these bonds, this bond is like a certificate representing the issuer's indebtedness to investors. That means, the issuing company, they issue this one to investors, the insurance company. Then this bond is the evidence of that borrowing or that the indebtedness to investors. And then there are two obligations for the issuers, the borrowers. Two obligations. One is you pay the fixed the interest payment typically and every 6 months or 1 year, depending on the contract. Um, so this periodic interest payment is one obligation, and one specific amount of money at maturity is at maturity. So it's the par value, which is par value or principal value. So these two cash flows, these two cash payments are the obligation of the issuing company. Okay. So if you look at the first cash flow, that's the series of cash flow, multiple cash flows, right? The specific rate of interest at fixed interval every 6 months, every year. And the next one, second cash flow, that includes just one-time cash payment at maturity. All right. So that's just one single sum. Now, bond issuers typically include the corporations. We talk about corporations there, right? Just corporate bonds. And then the U.S. government, we call treasury bonds. Treasury bonds is a long-term bond. And if it is like intermediate term, that's called treasury notes. Treasury notes. if these bonds are issued by state or local government, municipal government, then it is called municipal bonds. Right? Municipal bonds. All right. So let's talk about corporate bonds. Corporate bonds. If the bond issue is secured by some kind of property or assets, we call it secured bond. Secured bond. If it is not secured by anything, then it is called unsecured bond. Now, the first one, secured bond, we have mortgage bond, collateral trust bond, and equipment trust certificates. So these secured bonds are secured by something, some asset, some property. The first one, mortgage bond, as you see, this mortgage bond are backed uh, backed by the real estate property. Okay, collateral trust bonds are secured by the financial assets like stocks, bonds, and others. Okay? Equipment trust certificates, they are secured by some kind of transportation, the vehicle, train, cars, and airplanes, the ships, that kind of. So mortgage bond, naturally mortgage bond are popular in the real estate industry, and collateral trust bond are popular in financial or investment industry. Equipment trust certificates are popular in transportation industry. Okay, that makes sense. Okay, unsecured bond debentures. Debentures are not secured by anything, any asset or any property. They are only kind of backed by the company, issuing companies like name or the credential, right? Or financial stability, right? So this one is called debentures. So, normally secured bonds are safer and more stable than unsecured bonds, naturally. Right? U.S. government debt securities, we have you know, three different types depending on their maturity. Short-term maturity, less than 1 year, it is called U.S. T-bills. U.S. T-bills. And if it is the intermediate term between 1 year and 10 years, it's called Treasury notes. And if it is longer, the maturity is longer than 10 years, it's called Treasury bonds. Right. And then U.S. and also U.S. government agency bonds, government agency bonds like Ginnie Mac, Freddie Mac, right? And then municipal bonds are issued by state government, county government, or city government. Okay. Let's talk about this bond valuation there. Okay. All right. The basically the valuation theory or valuation model, the basic principal idea of the value of security valuation, is the sum of, if you look at this one here, the sum of present value of future expected cash flow. Right? This moment. All right. If you look at this one here, the valuation model V is equal to sum of present value of future cash flows from that security. Okay, so that is here the universal principle theory. Okay, so sum of discounted future cash flows. The same thing, right? Discount, that means present value. The sum of present value of future expected cash flows, or sum of discounted future cash flow. That's the same thing. The sum. Okay. Now bond, as you see, like bonds are the company, the corporations or governments, like obligation. So it is called debt security. Debt security. Typically maturity and years. Let's talk about years. Par value. Par value is the $1,000 at maturity. And then coupon interest payment. I said, as I said, they have to pay periodic interest. And bond interest. Bond interest, that is the interest rate for bonds um, um, to be used as discount rate. Okay, given the four variables, we compute, for present value, bond intrinsic value there. Now, if I show you all like bonds, the variables, characteristics on timeline, this is it. We talked about the timeline last time, right? Time value of money. So, so time horizon is n year, and then bond interest rate is 8%, and then coupon payment every now we assume that the coupon interest are paid annually, and then we'll change that to semi-annually. So we have 10 times of coupon payment. Okay? So this one cash flow and another cash flow is the $1,000, the par value at maturity. At maturity. So that is what's happening for this bond. Given all this information and variable, our job is to calculate what is bond. Is value, bond value. As I said, bond value is the sum of future, sum of discounted future cash flow or present value of future cash flow. So V is the sum of discounted future cash flows, the C coupon payment and par payment. So we'll do this one. If you do this one manually, it will take forever. But we will do that and using Excel. Okay. So intrinsic value is the intrinsic value of asset, as I said, the present value of future cash flows within investors' required rate of return as discount rate. We'll get there. Now, let's do calculation here. Now, 5-year bond by Toyota with coupon interest 4.35%. Investors required rate of return is 3.6% rate of return. Okay, that's pretty good. All right. One thing about this one, coupon rate, this is coupon rate, right? Coupon rate is not bond interest rate. This is coupon rate, just coupon interest rate. This one is used only to determine the amount of coupon payment. So if the coupon interest annually is 4.35%, your your annual coupon rate is 4.35%. 4.35% times the par value. Par value is 1,000, right? 1,000. That is how to calculate. That is how to calculate your coupon, the annual coupon rate. So par value, let me get rid of this. If you do this one, that will give you the amount of coupon payment, from this bond, right? So it, and then let's do this. 4.35% times $1,000. This one is $33.50. $33.50. That is the amount. That is the amount of coupon payment. Okay, $33.50. So that means you will receive. The investors will receive $33.50 $43.50 and $43.50. That is the coupon interest payment from this one here. And another cash flow is $1,000 at maturity. Okay. So given this cash flows, and the bond interest rate, the market interest rate is 3.6%. That's you locate this one as K is 3.6%, and then this the bond time horizon is 5 years. So 5 years, 3.6% investors required rate of return, and coupon payment is $33.50 and $1,000. This is all picture, related picture from for this 5-year bond by Toyota. Okay. Now, if you want to solve this one using financial calculator, this is the one. You just identify this 4 component and you compute for, or solve for present value. So N is 5-year bond, and coupon interest rate, not coupon, bond interest rate is 3.6%, and then PMT, that's the $33.50. Now, in this case, one thing you should be careful is, now, no, you don't have to. This is the investor. You are investors. You are in the investor's perspective. So you will receive $43.50 every year. Okay, so you receive $43.50. Okay, and then future value is $1,000. So you identify these 4 components and you are solving for this present value. That's what you do. Okay, so using financial calculator, 5 for N, 3.6 for I, 33.5 for PMT, $1,000 for future value, and then compute future value. That's how you calculate. All right. Okay. All right. Now, since we are on Excel, let's use Excel. Now here, present value. We are solving for present value. Then you are given this menu, right? Rate is 3.6%, and end period is 5-year bond, and then PMT we see $43.50, right? And then future value is $1,000. That's it. See, you input this 4 component and solve for the present value. It gives you $1,033.77. So the reason why it comes out as negative value is to get this bond, this cash flows, you have to pay $1,000, $33.77. So that's your payment. That's why it's in negative value, right? Okay. Now that was the easy one, like annual. If the coupon interest is paid annually, that was easy, right? How about semi-annually? If it is paid semi-annually, it's the same thing. You just make adjustment, just one adjustment. Yeah. That's it. Coupon interest payment. Coupon interest payment, if you see, that's the 4.35%. As I said, you have to multiply that by the par value, right? Par value. But this time, look at this, 4.35% times 1,000. That's for 1 year. But this one is paid semi-annually. We assume semi-annual coupon payment. So it's not $43.50. you have to divide that by 2. Okay, that's one adjustment that you have to make. You see that? So that one is 4.35% times 1,000 divided by 2 is $21.75. $21.75. That is the amount of coupon interest you receive every 6 months. Right? June 31st and June 30, you will receive $21.75, and then December 31st, you will get this another $21.75. Okay? Bond interest. Bond interest 3.6%. That is for 1 year, right? 1 year. We have to make it to periodic, semi-annual rate. It is 3.6% divided by 2 is 1.8%. 1.8%. This is the same adjustment here, right? Par value, you don't need any adjustment here. That is the same. And should be like it was 5 years, right? It was 5 years, but that was for years. You have to change that to, the semi-annual. So you have to multiply that by 2, which will be, which will be 5.5 times 2 is 10. So 10 period. 10 period, 10 6 months, that's 5 years. Okay? Timeline here, given all this information component, the interest rate is, 1 periodic interest is 1.8%. Total number of period is 10, not 5, 10. And then here, the coupon interest is 21.75 each year, 21.75 each period, and 21.75. So you will receive 10 times of this $21.75. Okay. Now, given all this information, you want to calculate this intrinsic value. Intrinsic value. So, what is the bond value given this? Oh, by the way, there's one par value there. One par value should be there. So, okay. Now, so this is your bond intrinsic value. Financial calculator again. This one is 10. So that's n should be 10. I is 1.8%. 1.8%. PV, that's a question mark. And then PMT is $21.75. And then $1,000 for future value. Given these 4 components, you calculate the present value. All right. Let's do this in Excel. Present value. You are given this formula. The rate is 1.8%, and then end period is 10, and then payment is 21.75, and then 1,000. That's the future value. So enter these 4 components and compute the present value. That's the bond value. You have $1,034.04. Okay. Now we did one is the annually, one is the based on assuming the annual coupon payment. The second one is semi-annual coupon payment. Now, if you look at the outcome, you see semi-annual coupon interest, semi-annual a case that gives you slightly more expensive, right? More expensive. They are very close, but this one is, a little bit higher. So if you have more compounding period, so semi-annual has more compounding period than annual compounding period, then your outcome, your result will be slightly higher, right? Okay. That is how to calculate bond intrinsic value. That's pretty straightforward, right? So just in the process, bond valuation process is given, I mean, entering and given these four components, and then you compute present value. So the calculated result is called bond value, bond intrinsic value. Okay. Uh, so up to this point, we calculated bond intrinsic value, right? Bond intrinsic value. Now, the second part, we will talk about yield to maturity. Yield to maturity. Now, this one is assuming this bond this bond is out there in the market. So if you buy this bond for the market price, then what would be your expected return on this investment? So you invest your money in the bonds that are traded in the market, and then you pay the market price. So that was your decision. So if you buy this one at the current market price, what would be your expected return, expected investment return? So that one is called yield to maturity. Yield to maturity. So the formal definition is the rate of return the investor is expected to earn if the bond is purchased at the current market price and held to maturity. All right. So that was the question. By the way, so we calculated the intrinsic value, right? By the way, that's one part here. This one, I'd like to mention this. If the intrinsic value, that's the value that we calculated, if that value is okay. By the way, I think this one is you have to change this one here. Change that the direction this way. Okay, change that in your Excel. Now, intrinsic value. If intrinsic value is greater than the current market price, then that's a good price. There, let me explain. Now here, our calculated bond value. This is theoretical bond value, right? Theoretical value. If this value is greater than the current market price, then you have to buy it. For example, here in this case, suppose the current market price is $1,000, $1,025, $1,025. Let me change that to fine. Okay. Suppose this is the current market price. See, that is okay. Is the current market price P, right? This one is V, right? This one is V. So V okay, rotate it. All right. Okay. Look at this. The intrinsic value that we calculated is, as I said, theoretical value, right? Theoretical value was $1,033.77. But the same bond, I mean, the same or similar bond uh, is sold and traded at $1,025 in the market. The current price is $1,025. So the current market price is less than intrinsic value, theoretical value. All right. So what if this is the case? If you see this change, then what would you do? The current market price is attractive. So you want to buy. I said here, if the current market price is less than intrinsic value, then that's a good buy, good investment, right? Good investment. So you want to buy. This one is less than this one, and this one is attractive investment. So you go and buy them. And so why do you buy this one here? Why is this attractive price there? Because given all these the bond characteristics, our calculated the theoretical value is $1,033.77, but somehow in the market it is priced slightly lower than the theoretical value. We could say underpriced, undervalued there. Somehow it is underpriced. So that's the attractive, the price because in the near future, if this one is underpriced, in the near future, it is going up. It will be going up because the market is efficient. The market is efficient market, they will drive this one, push this one above and to approach to this theoretical value. That is the definition of the efficient market. Okay? Somehow, temporarily, this bond is priced below the benchmark, below the theoretical value. But since the market is efficient, this price is likely to go up toward $1,033.77 in the near future. So if you buy that at the $1,025 in the near future, you will get some, profit there, right? You will get some free lunch. Okay, that's why I'm saying this is good investment, and then that's why I say you have to buy them. All right, that's what that means. What that means. All right, now here we can do a similar discussion about yield to maturity. Now, yield to maturity, if yield to maturity is greater than required rate of return, investors' required rate of return, then that's a good investment. We'll talk about that. We have no idea what that means yet. Okay, so we are looking at the 10-year bond with the 8% coupon interest, and the par value is $1,000. And given the market price of $1,100, what is yield to maturity if you buy that at the current market price? All right. Okay. So 10-year bond with the 8% coupon interest. How do you calculate the coupon payment? 8% times $1,000. That is your coupon payment, annual coupon payment. All right. Okay. So this one is 8% times $1,000 is $80. You see that? $80. It is the annual coupon payment that you receive if you buy that. Present value, present value. Now, the current market price is $1,100. That means you have to pay $1,100 to buy this bond. So that's why I put negative sign there, right? Negative sign, because that's your payment. And the par value is $1,000, right? So if you put this one, this 10-year bond. So 10-year time horizon, right? And then your initial payment, the market price is $1,100. If you buy this one, and then what do you expect? You will get $80 each year, for 10 years, $80. And then at maturity, at the end of year 10, you will receive $1,000 there. So these two cash flows are coming to you if you buy this bond. Now, Right. Given and present value, payment, and par value, future value. Now you are asked to calculate rate, yield to maturity. It is called yield to maturity. Let's calculate this one here. I mean, if you use financial calculator, look at this. 10 for N, I, that's a question, right? And then present value is minus 1100. And then a payment is $80 and $1,000. That's the future value. Now, given all this information, you are asked to calculate I. Compute I. Okay, let's do that. Let's do that using yeah. Okay. Rate is uh, the variable that we are solving for in on Excel. Now, if you enter this rate, then you are given this for many. End period is 10 year, payment is $80 each year, and then present value is minus 1100. That is the bond price that you have to pay, and future value is par value there, $1,000. That's it. Enter and see what happens. 6.6% is yield to maturity. That is the calculated expected rate of return. I mean expected yield to maturity. All right, what this is saying? If yield to maturity is greater than required rate of return. Required rate of return is investors' required rate of return. Okay, investors' required rate of return. For example, it is not given here. Suppose if the required rate of return is um, 6%. 6%. If assuming required rate of return, investors' required rate of return is 6%, then what can you say? I said yield to maturity. If yield to maturity is greater than required rate of return, then that's a good investment. So in this case, yield to maturity is 6.6%, and then investors' required rate of return is 6%. So this definitely is greater than required rate of return. Yield to maturity is greater than required rate of return. So this is good investment. So you have to buy. You like to buy. All right. So this is the case when coupon interest is paid annually. But let's do the second part. If the coupon interest is paid semi-annually, and that's the same thing we did. So in this case, 8%, 8% times $1,000, that's for 1 year, right? But to get the coupon payment for semi-annual, 6 months, divide that by 2, then that one gives you, okay, 8% times $1,000 divided by 2 is $40, right? $40, that is what? That is your the coupon interest payment that you receive every 6 months. And present value is $1,100, and N is this time N is it was 10-year bond, 10-year is that 10-year bond, but in this case we assume one period is 6 months. So you have to change that, make adjustment. 10 years, but if I multiply that by 2, that is 20. 20, 20, okay, 20 years, 20 years, right? So, not 20 years, I'm 20 periods, 20 periods. Okay, so 20 periods, so 20 periods, 26 months. That's the time horizon. And then you pay $1,100. And then your periodic payment is $40, $40, and $40. That's the 25. And $1,000 is comes at the end of uh, year 10. Again, financial calculator, same thing, but the change is this is semi-annual. The 20, so N and I, that's a question mark, and then minus 1,100, and then $1,000. Okay, we. Yeah, payment is $40, and then $1,000. Okay, all right. Given all this information, you are asked for calculate I. See, that's it. I, great. And period is 20. Payment is 40. And then present value is minus 1,100. And then future value, our value 1,000. If you enter that, we give you 3.31%. 3.31%, but be careful here. 3.131% is for one period. One period, that means 6 months. That's for 6 months. You have to change that to annual. So just simply multiply that by 2. So 2 times this one here, 6.62%. That is your yield to maturity. Yield to maturity. All right? And then suppose if K if K is 6% again, and if K is 6%, and this 6.62% is greater than this required rate of return, so the yield to maturity is greater than 6% there. So this is good investment, attractive investment. All right, so we have this one here. We have this one, okay? That's for annual, assuming annual coupon payment. This one is semi-annual coupon payment, and this is how we calculate yield to maturity for each case. Pretty straightforward, right? All right, chapter 8. Okay, let's talk about stock valuation. Stock valuation. It's not equity, it's equity. Equity valuation. Okay? The difference between a bond is called debt security, right? Debt security. But this one is called equity security. Debt security, once the corporation sells this to investors, the corporation becomes debtor, right? So it becomes debtor. This is borrowing basically, but this one, so the corporation should pay back. To pay back. In this case, they have to pay interest payment and par value repayment. But this one, equity security, this one, the corporation, they are selling, I mean, they don't borrow. They sell their corporate ownership to investors. So if we buy the common stock, especially common stock, then we become part of automatically become part of the ownership of the corporation. So that's why it's equity security. This stock is not borrowing. It's not borrowing. They sell, the corporation sell the company's equity for ownership to investors. That's why it is called equity security. All right. Eric, can you read the purpose stuff?
Sure, preferred stock, a hybrid security because it has characteristics of both common stock and bonds. Like common stocks, preferred stocks have no fixed maturity date. Failure to pay dividends does not lead to bankruptcy, and dividends are not a tax-deductible expense. And like bonds, dividends are fixed in amount, either as a dollar amount or as a percentage of par value.
Okay, thank you. Now, preferred stock. Preferred stock has the characteristics that are similar to bond and common stock. Right? So that's why it is called hybrid security. Hybrid security. So it has the common stock characteristics because the preferred stock have no fixed maturity, like common stock. Failure to pay dividend, preferred dividend, does not lead to bankruptcy. So, so the failure to pay dividend is not the end of the world. All right, it does not create that big problem. Dividends are not tax deductible, not tax deductible like the common dividend. That is, those are the characteristics of common stock. But dividends are fixed in amount, So typically, fixed in amount, that means it's just similar to the bond coupon payment. You see that? So it is already fixed. Uh, and theoretically, it's a model-wise, is a fixed forever. So preferred dividend are already determined, forever. But common dividend is not determined. Is not determined. It is not deterministic. Okay. Preferred stock dividend. If you look at this one, the preferred dividend, as I said, is the fixed forever, right? Fixed forever, like this. It is called perpetuity. And this cash flow is called perpetuity. So from preferred stock, you receive this perpetuity is the infinite series of preferred dividend, right? And then the required rate of return is our percent. Now, basically, the valuation principle, that means this intrinsic value of preferred stock is the sum of future value of all expected cash flow. That is now all future like preferred dividend, right? Same as sum of discounted cash flow, discounted future preferred dividend. Sum. So that is the evaluation principle. Okay? And then if you calculate this one, if you go through a couple of mathematics steps, then this preferred stock valuation, intrinsic value of this preferred stock, that comes down to annual dividend divided by required rate of return. That means P over R ES, preferred stock. Okay. See? It will be simplified as P over R. That's the preferred stock valuation. So, for example, suppose AT&T pays annual preferred dividend of $3.64. Then, if investors' required rate of return on this one is 7.28%, what is the intrinsic value of this preferred stock? It's simple. Just use this model. V over R. So $3.64 divided by, divided by 7.28%. 7.28%, that gives you your value, right? So $50 is the AT&T's like preferred dividend intrinsic value. The value of AT&T's preferred stock. It's easy, right? Now, let's go the other way. I mean, if you look at the bonds, we calculated what? We calculated intrinsic value first, and then we calculated ultimately based on the market price, right? Based on the market price, we do the same thing, yeah. Now, given the current market price of this AT&T preferred stock is $48, $48 in the market, and what is your expected rate of return on this preferred stock if you buy them at the current market price? See, here, if our theoretical computed intrinsic value of this preferred stock is $50, but the market sells this one at $48, which is slightly lower, which is lower than the theoretical value. Then, what do you think? Is it attractive price? Attractive investment or not? It is. It is because this AT&T preferred stock has the value of $50 theoretically, but somehow in the current market, it is traded at $48 in the market. So somehow it is underpriced or undervalued. So this is attractive stuff. So you would like to buy them. So now you like to buy them. So first, we know that this is attractive investment, right? A little bit attractive investment. Okay. If you calculate this one, I mean, the question here is, what is your expected rate of return? That means you have to solve for our rate of return using this, the model. So in this case, if I rewrite this one here, if I write for R, then you can replace this one, switch this two. So this one is D over V. You see that? V is D over R. R is D over V there. Okay. So in this case, we are working on the market price. So R should be D over not V, it's the current market price. Okay. That's it. So if you solve it, D is $3.64 and divided by the market price is $48. So you get this one. If we change that to percentage, here that is the your expected rate of return. So to be correct, R is this one here. R is this required rate of return. So R you could say expected. You could say R expected. I ask you, what is your expected rate of return? Not required rate of return, right? Required rate of return is here, R. So expected rate of return is RE is equal to P divided by P, that's a 7.58%. Now, we know this one is a little bit attractive stock, right? So how did we know? Look at this. Intrinsic value was 50, right? Intrinsic value was 50, and let me write. V was 50. P is $48. $48. Now we know we compared what? the intrinsic value and the current market price. And then when we compare this one, the market price is less than its theoretical benchmark, theoretical intrinsic value. So it is underpriced. So that's why we say this is attractive. Good investment. Good investment. That's one way to say. The second way is you compare expected rate of return. So our expected rate of return is 7.58%. And would you see that? I mean, you see that? R is equal to 7.28%. 7.28%. Now here, if you buy that at the current market price, $48 in the market, then your expected rate of return is 7.58%, which is higher than required rate of return. So this one is higher. So your expected return when you buy that at the current market price is higher than your required return. So that's why this one is good investment. Good. Right? So there are two ways. One is you calculate the intrinsic value and the current market price, and second one is your expected rate of return and required rate of return. This is how to do it. common stuff. James, can you read these characteristics of common stock?
Yeah, absolutely.
Yeah.
Common stock. Some characteristics of common stock. A certificate of the ownership of a corporate with voting rights. Source of return equals the dividends plus the capital gain.
Mm-hmm.
Unlike preferred stock, common stock, the dividends are not fixed. It's a variable income security.
Mm-hmm.
And dividend pattern varies among firms, but the dividends generally tend to increase with the growth of corporate earnings.
Yeah. Let's talk about common stock and common stock valuation. If you look at this one, common stock is the certificate of the corporate ownership with voting rights. So if you get the common stock, this common stock is the evidence of corporate ownership. So, suppose you have the 100 shares or 500 shares of the corporate common stock, then you automatically become part of the ownership. So you start to receive the letter from the corporation that they, about the company, about the shareholders meeting, or so you are asked to participate the shareholders the meeting, and then asked to give your vote for some things there. All right, you get these emails or mail. Okay, source of return, of course, dividend income. That's part of the income, and then capital gain, the price change. So two sources of the gain or return by investing in common stock is you get the dividend income and also the price increase in your stock price. That will be the second source of your return income. Yeah. Unlike preferred stock, this common stock dividend is not fixed. Now, I told you the bond coupon interest and preferred dividends are fixed forever. I mean, are fixed, pre-fixed, right? They're fixed. But common stock dividend is not fixed. So the first one, bond and preferred stock, we call fixed income security. But this one, common stock dividend, is not fixed, so it's variable. So we call common stock a variable income security. So if you hear like fixed income security or variable income security, then you have to understand why that is so. Okay. Dividend pattern varies among funds, but dividends generally tend to increase with their growth in corporate earnings. Right. You know, as I said, this common dividend is not fixed. It changes. It changes. When the company has like big, big, uh, the corporate earnings, then this dividend will increase, will jump. If the company has some financial problem and earnings is like negative, then the dividend might go down, go down. Okay, or sometimes they don't pay dividend. But generally, the big company, like the big company called blue chip, right? Blue chip, big manufacturing companies, they usually pay dividends, which are slightly increasing over time. So big, stable, established companies, blue chips, they pay dividend, and that dividend generally increase over time. Over time. Okay, that is the typical pattern for big established companies. Yeah. All right. Now, common stock valuation. The second part is common stock valuation. There. Now, given this information, yeah, as I said, uh, for example, R is required rate of investors required rate of return, and then it continues there. I mean, D1, D2, D3, there. The reason why I put D1, D2, D3, that means this dividend varies, changes, all right? Dividend changes. Sometimes increase, sometimes decrease, sometimes decrease. But as I said, like big established, large established companies, D1, D2, D3 usually increase over time. Okay? All right. When we talk about valuation, the general principle, as I said, is that the value of this common stock is sum of present value of all future cash flows. In this case, all future common dividends. Right? So sum of discounted future dividends. That's the general principle. And, in bond case, it will be sum of discounted, the coupon interest payment, future coupon interest payment, or future cash flow. All right. Dividend grows stably at the constant annual growth rate. This is not all the time. Okay, not all the time. Some companies like dividend changes like this: increase, sometimes decrease, increase, decrease, or increase, increase, something like that. I mean, it's small company or medium companies, their dividend are less predictable. I mean, it changes, it varies. But if you look at the overall pattern, you can see like overall average. I mean, a growing pattern on average. You could say that. But if you look at the big company, large company, their trend is growing dividends over time. So that's why, I mean, we assume dividends grow stably at the constant annual growth rate of G. But that is not the typical pattern. But if you look at the overall, like change time series of this corporate dividend, you can see some pattern. One of the common pattern is it it tends to increase, right? Even though it is not stable, if you see overall on average tendency is to increase, over time. So that's why when you calculate the growth rate, you look at the 10 10-year period, for example, 10-year period, and then look at the dividend pattern, and then if it increases, then you get some kind of average growth rate. Okay, that was one way to estimate growth rate, using actual dividend number. That's one way, one alternative. Another alternative way is based on the financial statement. The growth rate is calculated. G is return on equity times 1 minus payout ratio. So that means return on equity times retention ratio. All right, that is how to calculate growth rate based on financial statement, and it is called, there's a name for this one. It's called sustainable. That is the name. That is the name for this. The growth rate, calculated growth rate based on financial statement. It is called sustainable growth rate. Okay. The first one that I told you, you actually look at the actual dividend for like 10-year period, and then you calculate like average growth rate. That is kind of your mathematical calculation for growth rate, right? Oh, but this one in our like textbook shows this sustainable growth rate. It is based on financial statement, and then it is return on equity times 1 minus payout ratio, or return on equity times retention ratio. That is your growth rate. Okay. Now, I told you the valuation model is this one here, right? Valuation model is basically the sum of discounted future dividend, right? If you do that and do that mathematically and go through a couple of steps of mathematical steps, then it will come down to D1 minus over R minus G. All right, D1 is the dividend at the end of this year. D0 is the dividend that was paid last year. Okay, and then G is growth rate. So if you look at this one here, that is the mathematical definition of growth rate in dividend, right? Okay. So let's do this. Suppose stock B's most recently paid dividend is $2.50 with the constant growth rate, and growth rate is 8%, and its required rate of return is 50%. Then what is its intrinsic value? Then intrinsic value is requires D1, right? D1. So if you look at this valuation model, we have three input there: D1, R, and growth rate. So once you calculate this, once you identify these three components, and then this valuation, intrinsic value is easy. Okay. So D1, how do you calculate D1? Yeah. D1 is $2.50. That's your most recently paid dividend. $2.50 times 1 plus growth rate, 1 plus 8%. It's $2.78. Okay. So to calculate this one here, D1 is $2.70, and R is 15%. 15% minus growth rate is 8%. That's how you calculate. Okay, based on this model. D1 over R minus G. You see that? $38.57. So let's change that to dollar sign. $38.57. And that's the intrinsic value of this stock. Okay. Suppose this stock sells for $28 in the current market. Now, first, is it attractive stock or not? Anybody answer this question? What do you think? Our intrinsic value, theoretical value, is $38.57, but the current market price is somehow $20. Would you think this is an attractive investment? Would you like to buy? Anybody? Allison, would you buy?
Can you re-explain again
Huh?
for us?
Huh?
Can you re-explain like the intrinsic and the extrinsic numbers?
Yeah, intrinsic value is the theoretical value we just calculated, right? So it's a
Okay.
theoretical value. Now, this current market price is the market price that is this security, this stock is traded for. So you want to buy this one? Would you like to buy this?
No.
Because,
If the $38 is what I'm paying for it and it's
no. What you're paying for is $20 in
okay.
the current market.
Okay, yeah.
Then
Sure.
that's right. That's
Yeah.
right. You know, you want to buy this one here. This stock has the value of $38, but somehow, amazingly, it is traded at $28 there. You see that? It's if you so you want to buy that. In this case, you want to like run and grab them, right? So if you buy that at $28, it is likely that this price will go up to $38.57 in the near future. It's your free lunch. This should be a delicious sushi lunch there. Okay. So it's underpriced quite a bit. Underpriced like $10. So you want to buy them. You want to buy them before it goes up to like $30 or above that. So if you buy this one at $28, what would be your expected rate of return? That's the question, right? That's the question. So this question asks you to solve for R. So if we change this one for R, R should be, look at this. Let me step by step. R minus G should be equal to, based on this model, it's equal to D1 over V. That is the model. I mean, if you reorganize this one, switch this to, and that you'll get this. And this one will be R is equal to D1 over V plus G. You see that? You move G over to the other side with the opposite sign. We have to use this one here to calculate this one. Oh, okay. It is here. R minus G is C. This one is wrong, right? This one should be C. I thought I changed that. Okay, 0. We don't get that. And this one is C. Oops. See, that is the one, right? Change that one here. So D1 over V, D1 over P, you have to change that to P because the current market price. And then it comes down to P1, and this one is P. See? So D1 over P plus G, that is how you calculate. So let's do it. D1 is $2.70 divided by $28 plus growth rate is 8%. 8%. That's how you calculate for the expected return. Actually, oh my goodness, what is this? Yeah. To be correct, this one should be expected. So, expected. Let's just add expected. Okay. So expected, see that your expected rate of return of your investment is D1 over P plus growth rate is 17.64%. Right, 17.6%. So the last question is this one, would you buy that or not? That would be my last question. Then we already know the answer, right? So what we did was here, V is equal to $38.57. And we know that our P value, the current market price is $28. You see that the $28 market price is substantially lower than the intrinsic value. So this one is attractive, good investment. Okay, that's one way. And second way is RE is equal to 17.64%. 64%. And when we compare this one to required rate of return is 15%. Look at this. The expected rate of return is quite higher than required rate of return. So we say this is good investment. Good. Okay, so that's how you use this information for your investment decision making. So I just gave you typical example, and like the upper level, like the investment decision making, investment analysis and decision making, that will be done this way, but in a more upper level. Okay, if you want to do that kind of security analysis, then you could come to like investment management class, right? That will give you everything about much more like full version, full picture of like valuation analysis. Do you have any questions? All right, let me take attendance. Take a picture. Not this way. All right. I think a couple of left. All right. Okay. Do you have any questions? All right. Then have fun with your homework assignment and quiz. I'll see you next Tuesday. All right. Okay, this moment.
Thank you.
Okay, thank you.